Today we are going to be produce a video. That video will give you full concept of risk and rate of return. This video will be bring a different dimension for the students. Those are really interested in understanding about the share investment and their returns. Here we'll discuss about the standard deviation risk, beta risk, and we'll discuss about how to measure or manage the market risk as well. Thank you to all of you for watching my videos, liking and subscribing. Thanks for all my viewers, those are giving a good comments always on my video, and also your criticized comments, because your criticism is giving me a new direction to develop my videos. Be with me always, you will get a good learning, as you know that this is an educational site. Thank you. Risk and rate of return. Introduction. This video brings together the concept that underline the valuation of securities and their rates of return. In this video, we are especially concerned with the common stock, preferred stock and bond. We also look at the concept of investors' expected rate of return on investment. Fisher effects on inflation on rate of return. The Fisher effect is an economic theory created by economist Irving Fisher that describes the relationship between inflation and both real and nominal interest rate. According to the theory, when a rate of interest is quoted, means mentioned in front of the securities, it is generally known as nominal rate or observed rate. The real rate of interest represents the rate of increase in actual purchasing power. It is after adjustment of inflation, definitely. Thus, the nominal rate of interest is equal to sum of real rate of interest, the inflation rate, and the product of real rate and inflation rate. Fisher effect concept. As per the Fisher, he said that nominal risk-free interest rate, that is mentioned with a KRF, K is representing cost of capital and RF risk-free rate, is equal to a real risk-free interest rate is plus inflation risk premium. Fisher equation we can describe like 1 plus KRF is equal to 1 plus K multiplied by 1 plus IRP, is risk premium or inflation rate. Let's understand through the example. Suppose the real rate is 3% and nominal rate is 8%. What is the inflation rate premium? We'll go for the solution. As per the Fisher equation, you know that 1 plus nominal rate is equal to 1 plus real rate in bracket 1 plus inflation, as we shown in values, or you can show in a explanation way. This is an explanatory formula what we showed in a previous slide. So let's drive the same formula and put the values here. So nominal rate is mentioned 8%, so 1 plus 0.08 is equal to real rate is mentioned here 0.3%, so 1 plus 1.03 means 1 plus 0.03 is become 1.03 multiplied by 1 plus IRP. We don't know about the inflation premium or inflation rate. We should calculate in this. So let's say once you will describe the formula, you will get the value of IRP is 4.85%. So it is mentioned here the inflation rate is 4.85%. It means inflation is 85%. Term structure of interest rates. The relationship between the debt securities rate of return and the length of time until the debt mature is known as the term structure of interest rates, or the yield to maturity. A is equal to the yield curve upgrade when rates are increasing. B, the yield curve may be downwards sloping or inverted if rates are expected to fall. Let's go with the graph to understand in a better way. So the A, this is mentioning graph is upward, it means the rates are increasing. So graph is going upward, yield to maturity is increasing along with the time to maturity. Same as if you are going for the B concept, it means yield to maturity is declining as per the time maturity. So this is the second time structure. In term structure, both possibilities are there. It's depend upon our investment. Risk-free securities. Treasury bonds, or we can say Treasury security, is considered the risk-free security because the rate of return are fundamentally free of default risk. Why free? Because the federal government is committed to return the money, whatever investment is there. Even though in the way that if there is any problem, they will print the dollar and return the money to their investors. So we can say that the treasury bonds required rate of return is equal to risk-free rate of return. So wherever we will quote the treasury bond, we must be keep in our mind, this is the risk-free rate of returns. Then the question arises that what is the corporate, means share or bonds required rate of return? It means at what point or what percentage we can invest the money in the securities. So we'll examine another formula. Required rate of return is equal to risk-free rate of return plus risk premium. It means if we need extra return, we must be go for the risk premium. Required rate of return is showing both as the minimum amount what we are receiving from the treasury bond, that is a risk-free rate, plus extra in return we need, that is a risk premium. So now the question is, how large a risk premium should be required to buy a corporate security? Means at what rate of interest you want to invest, or at what rate you are ready to take as a risk in a. Let's answer with the help of the returns. Expected return, the return that an investor expects to earn on an assets at its given price or growth potential, etc. Required rate of return means the return that an investor required on an assets or investment given at its risk and a market interest rate. Now we have to understand this chapter risk and rate of return, because this chapter is a really very important chapter. So after the case study you will learn many things. I brought one case study and we will continue this chapter through the case study. Come with me. To understand the risk and rate of return, let's assume that two different nature of companies like utility base and technology base. Suppose we will create the name of the company ABC Utility and ABC Technology Company. We will just write the tag here. Before starting the case, just I will brief to you regarding that companies. Utility means daily needs companies. A companies those are involved in the business is a daily needs, means a regular requirement is there in the business. And the technology based companies we are mentioning here, those companies are not daily based, but these companies are having new invention every day and the expected things are there. So let's go with the case for more understanding. Suppose expected rate of return. We will assume that situation of economy, or we can say that what the probability of our returns, ABC utility as well as ABC technology. A recession. If suppose a recession stage is there, it means business is in downward. The probability is suppose 20%, or you can say that 0.2 out of 1. ABC utility return is 4%, but ABC technology situation is minus 10%. Return will not become, and maybe your investment will give you negative return. It's assumed that's minus 10% in the recession situation. Keep again your mind why we take the utility company and technology company. You cannot be stopped to eat the food. You cannot be stopped to do the expenses on your daily needs, but you can stop the expenses for investing in technology based products. So that's why this type of companies maybe go downward during this recession, but utility-based company will at least continue. Like in Corona situation, COVID-19 came, and you know that what happened with the business, but utility business is continued. Normal situation, suppose probability is 50%, most of the time the situations are in the business is normal. So we can say that ABC utility company will give you 10% return, but technology company will give you better return like 14% because they are investing in a better way. And when you are going to be invest, you will be attracted with the new products and you will buy the products. That time the prices is also high for that product and the return would be high for the investors. And the boom situation. Boom means very much growth. Everyone is rich. Everyone have a money. They want to spend the money. They want to purchase the things whatever available in the market. So in this condition, when you are coming for a boom situation, probability is 30%. ABC utility companies maybe grow 14% because high growth is not there. Whatever you are eating, maybe you will buy some extraordinary product, but normally for eating purpose. So the growth will not be, the percentage will not be go very high. But in technology based companies, you will buy a new cars, you will buy the new products, you will find the new invented products are coming in the market, even though very costly. So that's why the percentage of return will be increased like 30%. Let's examine both companies. For each company, the expected return on the stock in shares is just a weighted average. This is keep in your mind when we are calculating weighted average return. And the formula is total rate of return. We will mention with the K bar. We will put one sign upside, so it is known as total return. Total return in this whole video we are showing with K. K is representing the cost of capital, as I told you, and when we'll put the line on upside the K, it is known as K bar. And whenever we are showing the total rate of return or total any amount, we will show with the bar sign, is equal to PK1 multiplied by K1. PK1 means we have a probability against the return, and the return for K1 we are showing as a return, plus PK2 multiplied by K2, it means probability for second investment or second situation multiplied by second return, and so on up to PKN or multiplied by KN. So here just I will describe the formula in a more or broad way. The thing is there, in previous case we took only 3 situations, but sometime maybe situations are 4, 5, whatever is there. So we can use the PK 1, 2, 3 or K1, K2, K3 as so on up to the number of investment or number of returns or number of probabilities. So keep in our mind, in our case we are having only 3 situations. It means 3 K1, K2, K3, as well as we are having 3 probabilities. We'll put P1, P2 and P3. Let's calculate the weighted average return for ABC utility based company. Now we'll go for the first utility based company and try to understand what would be the total rate of return. We'll draw the same table as we discussed before. All situations are here, there is no change, but we are focusing on probability and the return of ABC utility. Let's put these values in the given formula. So formula as we described before. Now we'll put the value and we get the total return. It means total return is 10%. It means average return for utility based company is 10%. Let us go with utility technology based company. We'll draw the same table. We'll keep the values here: economic situation, probability and returns. All 3 situations are there: recession, normal and boom. Now we'll go for a probability as well as now technology based company. Now these values we'll put in a given formula. Let us see what is our total return. So total return is here 14%. So in both situation, if the investors are investing in both company or in any one company, so those are investing in a technology based company, they are having higher return than utility based company. Then what is the result? So now the time to analyze the situation. Now we discuss two situations. Question 1. Suppose based only on the expected return calculation, which stock would you prefer? So definitely, or you can say surely ABC technology-based companies stock due to the high return. Because if you invest with the stock technology-based company, your return is high even though the first time it was negative. Doesn't matter. Now the second question is arise in our mind that have you considered the risk? This is very important because we are discussing about the return against the risk. Each investment have some risk. So we need to know that what risk is associated with technology based company as well as utility based company. So we must be consider or calculate the risk here. What is the risk? Risk can be defined as the possible variation in cash flows about the expected cash flow to the possibility that an actual return will be differ from the expected return, uncertainty in the distribution of possible outcomes. We'll continue with this. Uncertainty is a distribution of possible outcomes are. We can say that suppose company A and company B, companies A returns are very heavy and more, but company B's returns are, you find that many bar pillars. So this situation would be there. So we have to be understand that both situation and then we'll invest our money in. How do we measure the risk? It is what the calculation, how we can calculate the risk. One of the scientific approach is to examine the stock's standard deviation of return. So it means as you are very much aware with the statistical tool, a statistical formula that is showing that standard deviation, how to calculate standard deviation. Here in finance, when we are discussing about the standard deviation, we are measuring the risk through the standard deviation. Standard deviation is a measure of dispersion of possible outcomes. The greater the standard deviation means the greater the uncertainty and therefore the greater the risk as well. So once we will calculate the standard deviation, if number value will become high, we can consider this is a risk. So when we are going to be compared 2 or 3 situations, then only we can go through any decision. And here we are having 2 situations, utility based company as well as technology based company. Will continue with the same. In continuation, let's start standard deviation formula. Standard deviation formula is mentioning summation sigma is equal to under root n summation I is equal to 1 in bracket ki minus k means total return because bar is mentioned on upside of the k whole power square multiplied by pki. Pki is a probability index. So this is the one situation when we are going for a multiple situation, we have to be use the formula and get to know the standard deviation. Let's go through the above case and understand the standard deviation for ABC utility based company. As you know that bring the value of ABC utility based companies from the above case. Let's examine what is the KI. KI means K1, K2, K3 as so on. In above case we are having only 3K. It means K1, K2 and K3. Where you know that the K1 is given in the table 4%, K2 is 10% and K3 is a 14%. Overall K also we calculated that was 10% as we calculated overall return. Put the value in the given formula. Before that we have to know that what the probability index also given in the table. If you go through that, P1 we will put suppose 2%, P2 is 5, 50% as mentioned over there, and P3 is 3, 30% mentioned over there. So these information are given. Now just put this information in the formula. So let's Ki means the K1. So K1 is 4% minus K bar. K bar means total return is a 10% square multiplied by probability. Probability for first situation is 20%, so 0.2 or you can put 0.20 is equal to 7.2. Same as in second situation we have a K2 is 10% and overall return as well 10% square multiplied by probability 50%, it's become 0, same as in third situation. And then we'll go for the difference, means variation. What the variation is there? So total variation or variance is 12. And now we didn't put the under root value, we have to calculate the under root value of variance. So standard deviation is equal to under root 12. It means the standard deviation is 3.46% for utility based company. Now let's go for the technology based company or ABC tech company. Same situation again. We know that here K1 is equal to minus 10%, K2 is 14% and K3 30%. Overall K means cost of capital, we calculated 14% for this company. Probability is same, P1 20%, P2 50% and P3 30%. Let's put these values in the situation again, in the equation again. So minus 10 minus 14 square multiplied by probability, we'll get 115.2. 14% minus 14% square, 0.50% is equal to 0. 30% minus 14% square multiplied by 30% is become 76.8. And the variance is 192. Let's go to calculate the standard deviation. 192 under root is become 13.86%. So in this situation, we get to know that the standard deviation of technology based company is very high than this company. So there are two questions. Number one, which stock would you prefer and how would you decide? First is easy to know that how we are going to be choose the first, and then how we'll decide which one is good, which one is not. So let's answer the second question first. On the basis of return and risk, we'll decide about the basis of return and risk. What is our return and what is our risk? We'll decide to invest in which project is based on that. Return means ABC technology based companies stock due to high return. Suppose we are purchasing, we are thinking to invest with the ABC technology based company because return is high. But if we are going to analyze the risk, ABC utility based companies stock, because as you know that the greater the standard deviation means the greater the uncertainty and therefore the greater the risk. This quotation we already quoted. So it means we don't want to take the high risk, then we have to go for the ABC utility based company. So those investors are looking for less risk, they will go for the utility based company, and those investors high return they are considering, they are going for a ABC technology based company. But there is a contradiction here. Let's continue. Now the time to decide the preference between the stock. It means which we have to go for investment. It is difficult to answer because different investors have a different requirements or different choices. So in conclusion, can say that it's depend upon the investor's tolerance of risk. It means we cannot give any particular decision that which investment is better. Like suppose if you are having a high risk tolerance capacity, or you are having enough money, you are not caring about the risk, you may go with the technology based company. But if you have a small amount of money what you want to invest for your future earning basis, that time you will not take the risk with the technology based company, you must go with the utility based company. So two type of investors have a two type of opportunities to invest in the market. They can choose their investment, their security as per their requirement. Hope you understand with this case. So let's continue. Why portfolio? The question is coming that I want high return, but I don't want to take that much of risk. So in this condition, one word is telling investors or financial analysts that go for the portfolio. So why portfolio? Let's examine the portfolio. Combining several securities in a portfolio can be actually reduce overall risk. So this is the one reason. We want to make the portfolio because we want to reduce the risk. How does this work? Let's go through the graphical presentation to suppose we have a stock A and stock B. The return on these stocks do not tend to move together over a time. They are not perfectly correlated. So we can make portfolio and reduce the risk. It means let's go for this. Now we'll examine this. We have a rate of return and we have a timeline over here. If you saw the two lines is there, one is with the orange color, one is the blue color. This is two investment opportunities. It means if you see that their investment, their return are vice versa. When orange is going up, blue is coming down. When blue is going up, orange is coming down, and so on. So in this condition, if we want to invest with one, we have to take the risk, maybe decline at the time of when orange is increasing. So in this type of investment, we need to know that where to investment. So we are making one portfolio that is showing that KP. K means cost of capital, means return on your investment with the portfolio. So we are going to be invest with both company, and whatever average will become, it will become in between. So it will be shown as KP. So we will not go for KA and KP totally. Some percentage of investment, as we show that some percentage will show with KA, some with KB. So at least we will maintain our return. So this is the graphical presentation why we are going for a portfolio. So let's more understand through the example. Suppose you own portfolio consisting the following stocks. Like here we choose 5 stocks from the market A, B, C, D, E. Percentage of portfolio. Suppose the money what we are having to invest in the portfolio is 20%, 30%, 15%, 25%, and 10%. It means total 100%. It means if you are having $100, you can invest in this way: 20 with A, 30 with B, and 15 with C, 25 with D, and 10% with the E. So you will be invest your $100 along with this type of company. Here we will consider the beta risk. I will explain later on that what is the beta risk. After standard deviation, we have one more financial risk that is known as beta. Beta, suppose for A is 1, B is 0.85, for C 1.20, for D 0.60, and for E 1.60. Expected return. If you are investing with the A, you may expect you will get 16% return, with B 14%, with C 20%, with D 12%, and with E 24%. This is the situation. This is the opportunities are available in the market. What you want to put in your portfolio. So the risk-free rate is 7%. It means if you don't want to invest with A, B, C, D, E, you will get minimum 7% from the market. So this is a risk-free rate. As we discussed before also, it is mentioned that investment in bonds. And the expected rate of market portfolio is 15.5%. It means if you are going for a market return, you will get 15.5% return. Now calculate the expected return on your portfolio, or calculate the portfolio beta as well. We are going to be calculate two things. Let's start with the one. The portfolio expected return we will show as a KP equals to weighted average of the individual stock expected return. KP is equal to, we'll just put the values. Probability is 20% and return is 16%, plus probability is 30%, return is 14%, as we put in a before when we calculated the expected return. So we'll put the value of each and we'll get the KP value is 15.8%. In this portfolio, if you are going, your return is 15.8% instead of 15.5. It means your return increased in this situation if you are going with this portfolio. Let's go through the risk as well. The portfolio beta means BP, beta P is equal to weighted average of individual stock. So we will calculate in the same way that beta portfolio is equal to probability of investment in 1, then the risk was 1. For second project, we have a 30% investment, that risk was 0.85%. If you are going for third investment, it is you are investing 15% of your money and the risk was 1.2520. Fourth investment, you are investing 25% of your investment money and the risk was 0.60, and 10% you are investing with the risk 1.60. It is very high. So let us see the value is coming BP1, means portfolio beta is 0.95. Portfolio beta is 95. It means we are going to be reduce our risk. If beta is 1, I will explain you later on. If beta is 1, it is known as a market risk. Market return was 15.5%. Here we got 15.8%. It means better return with less risk. So this is the portfolio. Understand the diversification. investing in more than one security to reduce the risk. That's why we are diversifying our securities, not investing in one. We are going to be invest with the second. If two stocks are perfectly positively correlated, diversification has no effect or there is no risk. It means both are going up, both are going down together. So whether we will go with first situation or second situation, it will not be affect. So it means there is no need for diversification. But if two stocks are perfectly negatively correlated, the portfolio is perfectly diversified as we mentioned in the previous example. Can you have eliminate all your risk? No. Common stock portfolio still have risks. When you are investing with the company, you know that we already previously discussed when we discuss about the securities. Common stock is always the risky investment because you are the owner. If company is having anything, you should be bear that risk. So that is a different type of risk that you cannot be reduced. So the other thing is there, can all risks be diversified? This is another question. Let's answer this question with no. Again, we cannot be diversified all risk. Then the question is coming that why? To answer this question, some risk can be diversified away and some cannot be. Market risk is also known as systematic risk, is non-diversified. This type of risk cannot be diversified away. Suppose second risk is company's unique risk. It means a company's internal risk. It is unsystematic risk. Is diversifiable. This type of risk can be reduced through the diversification. So unique risk can be, but market risk cannot be. So understand on market risk, expected changes in the interest rate. So if any interest rate change by the government, by the decision of states, so you cannot be able to change that. So that is a particular risk. Unexpected changes in the cash flows due to the tax rate changes, foreign competitions, and overall business cycles. So this is pressurized risk. This is a hurdle compulsory risk. You cannot be changed here anything. That is known as systematic risk. Now, company's unique risk, a company's labor force goes on a strike. If it is goes on a strike, now you are having, but you can manage it. You can avoid if you will fulfill the requirement of the labor. A company's top management dies in the plan crash. So if something happened with the top management, who is the decision maker, who is having all information regarding your company, company will be affected, but you can compensate to hire a good manager in that position. So this is a company's unique risk. Even a huge oil tank burst and floor of a company's production area. So something happened wrong during your production area where you cannot be work properly or labor cannot be work properly. So this is also, but this can also be managed. So unique risk can be managed. As you added this stock to your portfolio, company's unique risk is reduced. Let's example through an graph. Number of stocks, whatever you invest. Suppose market risk we shown with the orange color and company's unique risk we are showing on above. So portfolio risk is going to be reduced. First, we are working only on company's unique risk. We cannot be reduce the market risk. So you can see the graph is coming down. We can reduce the risk, whatever the unique risk is there with the time, with the stock. When we will add the number of stocks in our investment and our portfolio, we can reduce only unique risk, not the market risk. Hope you understand with these slides and you are enjoying the video as well. I know that it is very good or very understandable for you. So, do some firms have a more market risk than others? Yes, definitely. For example, interest rate changes affects all firms, but which would be more affected? This manage. Suppose we are having two type of company, retail, food chain and commercial bank. So if we are comparing between two, we get to know that commercial bank is having higher risk than the retail food chain company, as we examined also in a previous case. So just my focus is to understand with the above given cases. Important notes here. As we know, the market compensate investors for accepting risk, but only the market risk. So we need to work out to measure the market risk, because unique risk we can diversify away. This is why we have a beta. Now that time I told you that I will explain you the beta in the same video. So now you can understand the beta here. Beta is a measuring of market risk. So market risk we are managing through the beta. Especially beta is a measure of how an individual stock's return vary with market returns. It is measures of sensitivity of individual stock return to change in the market. Beta is always 1. I explained over there. Let us understand more. A firm that has a beta 1 has average market risk. It means all investments are having market risk. If beta is 1, we can say that all companies are having in a same position and same risky position. So that time we are deciding that beta should be 1. It means that a stock is no more or less volatile than the market. It means same risk is available, same volatility available as market. A firm beta is greater than 1 is more volatile than the market. If you are going to be invest with the high risk, so beta is shown as a risk. If you see that some companies are having beta more than 1, it means they are more risky company. And nowadays you can go through the Google, you can understand the company's beta is available, even though big companies like Amazon, like some central banks, you are going for a Samsung or you are going for any automobile companies, you will get their beta on Google. So you can come to know that these companies are having how much risk, whether the risky products are maybe not. So accordingly you can check. Example, technology based companies here, as I given more examples. A firm which have beta less than 1, it means less volatile. Example, as I told you, that utility based companies, especially the retail. Now we know how to measure the risk using standard deviation for overall risk and beta for market risk. This is just we discussed before. So now we are expert in this. You are also. How to reduce overall risk and a market risk through the diversification. Also we get to know that we can increase the number of securities in our portfolio, so we can diversify the risk as well. And now we need to know how to price the risk. So we will know how much extra return we should require for accepting extra risk. It means if you are having risk-free return is suppose 5%. So if your return, market return is given you risk more than that, then what price you want, what return you want from your investment, that is important to understand. And this is a very key point to understand when you are going to be invest in the market. Be aware, this is going to be interesting for you. What is the required rate of return? The return on investment required by an investors given market interest rates and the investment risk. Required rate of return is equal to risk-free rate of return plus risk premium. As we know that risk premium will come with the two risks. Number one is market risk. Number two is utility based risk or unique risk. But we will not care about the unique risk. Leave it. It means because we can diversify it away. So in risk premium, we will only consider about the market risk and beta. Let's come with me next. So capital assets pricing model, CAPM model, this is a very famous model and it is giving a very good snapshot of required rate of return. The capital assets pricing model describes the relationship between the systematic risk, that is beta, and expected risk, expected return, that is a K, and we know that K bar we are showing here, of assets. Mainly stock means CAPM widely used throughout finance for a pricing risk securities and generating expected return for assets, giving the risk of total assets and the cost of capital. This cost of capital we will discuss further. If you will go through my video working capital, you will get to know that how to know about the cost of capital. Even the full chapter cost of capital is also available there. You can go through the video, you will understand a lot of information through. Now we'll go for the CAPM equation, capital assets pricing model equation. Here again, K bar means total required rate of return is equal to risk-free rate of return. As you remember that we already show KRF plus beta. Beta is showing the risk and In bracket, we say that market risk minus risk-free premium. So whatever risk is available in the market, we will minus the risk-free rate, whatever available, so we will get the risk premium. Or we can say here the risk premium is a difference between the market risk minus risk-free rate. Keep in your mind, this is very important trick or technique, where K bar, as you know, that the required rate of return on stock, KRF, the risk-free rate of returns. It is also known as interest against your investment, and beta is a risk on security. Each security have each beta risk, and it is available or calculated by company itself to mentioning their investors. And KM, the return on the market index. It means if you are going to choose the return, you will get the expert advice what the market return is available or what return you will get against this investment. Let's example, suppose the Treasury bonds rate is 6%. It means, keep in your mind, Treasury bonds return is always risk-free return. So this is a risk-free rate. The average return on index is 12%. This is a market return because when we are talking about the average return, indexing return, this is a market reflection. ABC company has a beta 1.2. Suppose we are talking about the ABC company and the beta is mentioned by the company is 1.2. According to the CAPM, what should be the required rate of return on the investment or ABC's stock? So let's assume that what the minimum return we need from them at the stage of beta 1.2. So go for the solution. You'll just bring the equation and put the values in the equation as given above. We will get the total required rate of return of ABC is 1.132. It means 13.2%. So if you will get the return 13.2% from ABC stocks, you can invest. This is the required rate of return from ABC company. So according to the CAPM, ABC stock should be priced to give at 13.2%. So now you priced the value. So if ABC is offering return 13.2, you can accept. If they are offering less than, don't accept. If they are offering more than, definitely happily accept. Understand? Okay, there you go. Thank you very much for watching these videos. I covered many topics in this video for your understanding, and even though we have so many things to cover, required rate of return or risk with the risk. This chapter is really very big chapter. I try to compress with a very few slides, but in future definitely I will bring more information in a small videos as my habit, that once we are developing the full video, I am bringing the small topics for more understanding. That time we will discuss in a deep way about the CAPM, about the beta calculation and so on. Be with me, but don't forget to leave without like and subscribe. So thank you, bye bye, and see you in our next class.